Hi, it's Neil Frankel, Certified Financial Planner and owner of Wealth Resources Group, and also owner of WealthPilgrim.com. I thought I'd chime in on where I see the market and the economy at this moment. Greece and China closed their respective markets at different times during the year and curtailed trading in order to stop their markets from falling off a cliff, at least for a while. But the markets in the United States are open for business, and while it may feel like it's been a hard year for investors, the truth is the market hasn't moved all that much this year. In fact, as of January 31st, the market closed within a point of where it was in February. Some people say that August is a really bad month and we should prepare for the worst. Well, it's true that over the last 20 years, August hasn't been very kind to investors. The average decline has been about 4.7%. But is that a reason to head for the hills? I really don't think so. I say that because monthly patterns aren't really very reliable at all. Common knowledge is that January is a good month for investors and February is usually bad. But this year, January turned in losses and February saw a pretty decent rebound. And even though people expect March to be generally a strong month, it showed red ink this year. So these seasonal monthly patterns don't work. And if you want to understand why, think about the season, climate change versus weather conditions. You might take out your winter clothes in October or November to have them ready. But before you suit up for the day, you check the daily weather reports and you take a peek out the window, right? So it's important to understand the climate we're investing in. And it's even more important to get clear on the situation we're facing today. What is that situation right now? Well, lots of investors pulled money out of the stock market in July, and investor sentiment is low, as is investor sentiment. Investment advisor sentiment is actually low. And that might seem frightening to you, but traditionally, these two signal that it might be a good time to invest. That's because most people who invest based on their emotions get it wrong. And we can see that over patterns for many, many years. But in terms of data, manufacturing is slowing and the economy as a whole is expanding, but at a slower pace than expected. Economists predicted that the Purchasing Managers Index would grow by 0.2% in July, but instead it dropped by 0.8%. So that's not a good thing, but data, as always, it's muddled. It's not just one direction or the other. New orders increased to 56, and that suggests a better pace for economic growth. And production numbers also hit that 56 level, which is good. The bad news is backlog orders are actually contracting, and they're already at their lowest levels in 3 years, 42.5. So just to give you a way to understand these numbers, readings above 50 show expansion, readings below 50 show contraction. So overall, the ISM index indicates steady growth, but nothing to get super excited about. The brakes are being applied because of the global slowdown and the strong dollar, and because domestic energy prices are low. Now, low oil prices hurt many industries, not just oil companies, but it does help consumers and it helps other producers and businesses. Actually, outside of the energy sector, companies are already at capacity. So it's true that capacity hasn't gone above 80%, but it's getting close. And once it does go above 80%, companies will have no choice. They'll have to invest, expand, create jobs, and stimulate the economy. So if you look at the overall economy, it's made up of different sectors, and of the 18 sectors that report to the Institute of Supply Management, ISM, 11 turned in positive reports and 7 turned in negative. That's about par for the course. So, but if we move over to the picture for consumers, incomes were up almost 0.4% in July alone, and that's really good. Might explain why automobile sales are really revving up. GM, Ford, and other manufacturers reported sales that exceeded their expectations. So, in summary, most economists predict that the GDP will expand by 3% this year. It's better than expected, but it's not the strong rebound that experts suggest we need in order to ignite our economy. And what does this mean? It probably means that interest rates, if they go up, they won't go up quickly and they won't go up sharply. I don't know. I can't predict the future, but that's what I think it's reasonable to assume that. And it also means that market, and this is important, market performance is really going to be determined by corporate profitability. And that's another reason why I believe it's really smart to pay attention to the market and update portfolios, to focus on those funds which are doing well right now, because they've done the hard work for you. They found winning stocks. In short, I continue to believe that the market is much smarter than myself or anyone else I know. As a result, I'm going to continue paying attention to what it's trying to say. If you have any questions, drop me a line. I'd love to hear from you. And have a great summer. Try to stay cool, drink a lot of water. Thanks. For more great ideas on how to have no money worries no matter what, come on over to wealthpilgrim.com, sign up for your free weekly updates, and get a free e-course on how to make better investments.